is not a good how. So before you click on the buy button, you should know the risk which you're taking. You should know how much you will lose. You should know how much you will make. You should know your entry. You should know your exit. You should have a clear-cut plan. A trader who gets into something without understanding the risk is a trader who destined to fail. And it's kind of scary to see people trading options without understanding the basics of it, without understanding what Greeks are, without understanding what intrinsic or extrinsic value is, without understanding how the Greeks can impact the premiums, and trading options on earnings without understanding what IV crushes. If you don't understand what any of what I said just now, you're not ready to be trading options yet. I can understand looking at the screenshots, which you see on a daily basis on the Discord, can be a bit tempting to jump into the options. But again, people only show you one side of the story. The other side, the dark side, is the reality where people facing a bunch of losses, like losing everything which they made, losing months and months and months worth of progress in a single trade. People don't talk about it. Most of the people don't talk about it. So if you're going to learn options, better get started with the basics. In this session, we're going to talk about a few of them. We're going to cover what intrinsic value is. We're going to cover what extrinsic value is. We're going to go over every single option Greeks, and we're going to cover the basics of them. And we're also going to talk about what break-even price is. And we're also going to talk about the most frequently asked questions, like which strikes should I pick? Or which expirations should I pick? Or should I buy in the money or out of the money or at the money options? All these basic questions which every beginner option traders have. We're going to answer those, and we're going to open the floor for some of the questions from you guys. So you can ask some of the questions which are related to options and questions which you might have faced when you started trading options. So that's how we're going to structure this session as. So the first things first, we're going to start with what are calls? And I'm pretty sure if you were into options, you might have traded calls, you might have traded puts, but first things first, you're going to ask yourself, what are calls? What does it actually mean when it comes to the options? What does it actually tell you? When you buy a call option on any stock, that is any stock, if you trade SPY, it doesn't matter if you trade Tesla, it doesn't matter if you trade Apple, on any underlying equity. When you click on that call, what you're actually doing. And if your answer is, well, if I buy a call, if it goes up, I make money. It's not that. It's not just that. Yeah, you're going to make money as the underlying equity appreciate in value. But when you buy a call option, it's technically you getting into a contract with the market, telling the market that you are willing to buy 100 shares. You're giving yourself the right to buy the 100 shares of the underlying equity at the strike price of your call. For example, if you buy $480 call on SPY, technically you're getting into a contract with the market saying that, okay, I have the right, but not the obligation as a buyer. I have the right, but not the obligation to buy 100 shares of SPY at the strike price of my call here, which is 480. And now let's say you want to exercise that call during the expiration. You get to buy 100 shares of SPY, regardless of where the SPY is trading at. Let's say when during the expiration of the call, let's say SPY is trading at 487 or 490 or 495, your calls are going to be up big time. But you also have the right to exercise that call and buy 100 shares of the underlying equity. So that is the importance of the call. And if you've traded options before, you already know that the calls are going to appreciate in value as the stock price goes higher. As a retail trader, technically, when you buy an option, it immediately gives you the right to own 100 shares at the strike price of the call. But that's not the same when it goes to the institutions. That's not the same if it goes to the hedge funds. What they're going to do is they're going to go to their brokerage and they're going to tell them, okay, I'm going to buy an option, but I don't need 100 shares. I need you to set me up a contract with this much amount of shares, 50 shares a contract, the lots, 50 lots per contract, or 75 lots a contract, or 7,500 lots per contract. They're going to structure their options in that way. But for us as retailers, the options which you trade on a daily basis, it's just 100 shares per contract. So to repeat whatever I said, calls give you the right, but not the obligation, to buy 100 shares of equity at the strike price of whatever you pick. And it's going to appreciate in value as the stock price goes higher. And unlike shares, unlike trading shares, where like you can just buy and leave it there and it's going to stay there in your account, as long as the stock is getting delisted or going bankrupt, that shares which you buy is going to stay in your account forever. But it's not the same case with options. Every single option has an expiry date attached to it. So when that expiry date hits, it's going to vanish off from your account. So these are the basics of call option. Now the put options are complete opposite. Unlike call option, which gives you, when I remember the call options when we spoke about, which gives you the right to buy 100 shares of equity at the strike price. When you buy a put option, you're technically telling the markets, signing a contract with the markets, saying that you're willing to sell 100 shares at the strike price of your put by expiration. So let's say you hold like 100 shares of Apple and you're one of those traders who've been trading for like 20 years and you got lucky with the Apple and you are holding Apple at the cost average of $30 or $40. Now Apple is trading, I mean, this is before split, by the way. So now after split and everything, Apple is trading at around 190. So if you got it like 20 years back, your cost average will be somewhere around like $3 or $4, somewhere around that in Apple. So right now the Apple's trading price is at $190. So let's say you buy a put option on Apple and you're buying a put option at $200 strike. Yeah, you're going to make money as the stock price goes down. That's the point of the put option. But not only that, let's say something happens with Apple and the Apple just completely crashes and collapses like 30% in a day. That $200 put option which you have, it's going to give you the right, but not the obligation to sell your Apple shares, which you got at like $4 or $5 like 20 years back, at $200 each. And doesn't matter when Apple was trading at 140, doesn't matter when Apple is trading at 130, 120, when your put expires. You have the right to sell your 100 shares at the strike price of your put. That's the point of the put option. It gives you the right to sell your 100 shares per contract at the strike price of the put. And of course, yeah, you're going to make money as the stock price goes lower. And similar to calls, puts also have that time frame attached to it. And it's going to just vanish out of your account by expiration date. So these are the basics of calls and puts. Now let's talk about the subcategories of the options. So there are 3 different categories. You call it in the money, number 1. You call out of the money, number 2. And you call at the money, number 3. So if you're new to the markets, if you don't know what any of it means, let's just go over the basics of what in the money options are, what at the money options are, and what out of the money options are. So if you have your brokerage open, let's open SPY and check it out. For call options, we're going to first cover calls and then we'll go over puts. For calls, now SPY closed last Friday at $482. Anything under 482, let's say 480, 481, 479, 474, 475, anything under the current stock price when it comes to calls is what we call as in the money. Now, anything above the current stock price, which is anything above 482, let's say 484, 485, 490, 500, all that is called out of the money. Now, what do you call at the money strike price? So you see that 481 strike, which is like $1 under, 482 strike, which is right at that current stock price. That is called as at the money strike price. Now, when you go to the puts, it changes instantly. With the puts, anything above the stock price, it's considered as in the money. And anything under the stock price is considered out of the money. For example, SPY is at 482. So now let's say 483, 484, 485, 500, all these higher strike prices is considered in the money options when it comes to puts. Now, let's say you want to buy like 475 puts or 470 puts. All these are considered out of the money puts. So this is the basic foundations of it. This is what is called as in the money, out of the money, or at the money. So most of you who are trading options know until here. You know what calls are, and some of you don't know what about the right parts, which we spoke about. Now, we can only see the slide. I think the audio should be fine as well. Can you guys hear me? You guys can hear me properly, right? It should be good to go. So these are the basics: in the money, out of the money, at the money options. So he spoke about what are calls, he spoke about what are puts, and now we also covered what is in the money, what is out of the money, and what is at the money. This is where the fun begins. Now, this is where a lot of the questions start. How do you identify the break-even price? What is break-even price? So if you open your option chains, you'll see something called as break-evens attached to every single strike price which you buy. It doesn't matter if you buy 0 DTEs. It doesn't matter if you trade 2 DTEs. It doesn't matter if you trade weeklies. It doesn't matter if you trade monthlies. Every single stock, every single strike price has something called as break-evens attached to it. Let's talk about it. So the break-evens refers to how much the stock price need to move in order for you, by expiration that is. Let's say you have a bunch of SPY calls which expires tomorrow, and let's say you got like 480 calls, and you see the break-even price is 482. So let's say by tomorrow 3:30, SPY is trading at around 481. Even if you have 480 calls, that's still gonna be losing money because it's way under the break-even price. So that break-even price, what you see, that's gonna tell you where the stock price must be at your expiration of the contracts in order for you not to make any money or in order for you not to lose any money. That's by definition what break-even is. So for every strike price has their own break-even price. For example, 480 as mentioned before. And in this example, let's take like 480 calls. Let's say you spend like around $1,180 to enter this call. To calculate the break-even, it's pretty simple. Just add your strike price with the amount of money which you pay for the contracts. Let's say you buy something tomorrow. Let's say you day trade or scalp. Let's say you buy like SPY 485 calls, which expires tomorrow. And let's say you spend 60 cents, $60 on this trade. So that is a 485 call and you spend like $60. So 60 cents in options term. So technically the break-even price would be 485.60. Whatever money you pay, add that to the strike price and you'll get the break even. And that's where the stock price should be for you to not make any money or not lose any money, just to stay flat, breaking even. And let's say by your expiration, the stock is trading above your break even price, you're going to be making money. And even if it's trading 1 cent or 2 cents or 3 cents below the break even price, your contracts are not going to expire worthless if it's trading 3 or 4 cents under your break even price, but you're still going to be losing money. So that's break-evens, and that's how easy it is to calculate the break-even prices. I mean, there's a lot of people who have this question, or should the contract move until my break-evens for me to make money? It's actually not. Break-evens only tell you. Just a minute. All right, so the break-evens only tell you where, what's going on with the Zoom and why people can't join the Zoom again. Interesting. All right. So the break-evens are pretty simple. That's all it is. It's just telling you where the stock price should be by your expiration. So you cannot make any money or you don't lose any money. And you always got to make sure to pick the right price, right strike price, so that by expiration, the stock is trading above it. So this is how easy it is to calculate the break-even. And now all these are fine, and we need to talk about the important stuff. This is where we're going to go over what intrinsic value is and what extrinsic value is, and we're going to cover the basics of option Greeks. Every option premium prices which you see, and if you open your option chains, and you're going to see 480 calls has its own price, 481 calls has its own price, 482 calls at the same price, at a different price. Like every strike price has its price tag of its own. Those prices are split into two different categories. One is intrinsic value, the other one is extrinsic value. And the extrinsic value is also, and have you ever heard about this theta? And I'm pretty sure most of you guys, the theta decay is really messing up my contracts. You might have heard this term over and over and over again. In order to understand the theta, you need to understand what is intrinsic value and what is extrinsic value in the options contract. And here's the fun fact. The theta, which is actually messing up your account, messing up your options contract, is only going to affect the extrinsic value. It's not going to affect the intrinsic value at all. And if you buy an out-of-the-money option, out-of-the-money options only have extrinsic value. The only option contracts which has both intrinsic and extrinsic values are in the money options or at the money options. So it's easy for you to calculate how much intrinsic value you have on the options and how much extrinsic value you have on the options before buying them. This is how you do it. So open up your option chains, open up SPY and go to 480 strike expiring on April 30. April 30, 480 strike price. Pull it up. You will see the current SPY, the price of SPY when they closed out on Friday is currently at $482.30. And if you pick this contract, 480 strike price, which is expiring on April 30, the strike price, the price of that contract is $1,730, which means you have to pay $1,730 in order to open this contract. So the 1,730 is split into two terms. Number one is the intrinsic value, and number two is the extrinsic value. This is how you calculate it. It's a pretty simple formula. You can do it on any strike price which you pick. It's going to tell you how much money you're going to lose from Theta, especially if you hold it for a longer period of time, especially if you hold the same contract until expiration. So let's say SPY is trading at $482.30, and you're picking the 480 strike. Just subtract the current stock price with the strike price which you're picking. That's going to give you the intrinsic value. That's it. Simple. So with this example, if you pick up the April 30 expiration and spend like $1,730, and let's say into expiration SPY is just trading absolutely flat, you're going to lose somewhere around the ballpark of $1,500 on this trade, but not lose the $230. Because the $230 is the intrinsic value, and the $1,500 which you're losing, which is eroding away by the theta, that is the extrinsic value on the options, and you're only going to lose that. This goes for any in-the-money options which you buy. In-the-money options has two things, intrinsic and extrinsic value, while out-of-the-money options only have one, which is extrinsic value only. That's one of the main reasons why you see out-of-the-money options expiring worthless, while in-the-money options doesn't expire worthless. You'll always have some premiums left behind. The premiums which is left behind is what you call as intrinsic value. So if you want to calculate it, or open any stock of your choice. If you trade Apple, open Apple. If you trade Tesla, open Tesla. Look at the current price and look at pick any strike in the money. Any strike which is of in the money strike price. Take Tesla, for instance. I think Tesla closed at $212. So open Tesla and look for 205 strike price, which is like we spoke about it, which is in the money. And let's say the 205 strike price is going for somewhere around $900. So if you want to calculate the intrinsic value of the same, just subtract the current price of Tesla, $212, minus the strike price of your call option, which is 205, which is $7. That $7 is intrinsic value. And let's say Tesla just closed flat for the week, exactly at where you opened at, $212. You're just going to lose the extrinsic value of $200. That's all the thing which is Theta is going to eat away from. Theta is not going to touch your intrinsic value. So there are two things when it comes to the options premium: the money which you pay up front, whatever money you pay, like it doesn't matter if you pay $500, doesn't matter if you pay $600, doesn't matter if you pay like $10,000, it doesn't really matter. It's split into two different categories. And in the money options have intrinsic value and extrinsic value, whereas out of the money options only have extrinsic value in them. So hope this example was a bit clear. If you buy 480 strike price on April 30 expiration by spending $1,730, if you want to calculate the intrinsic and extrinsic value, just subtract the current price of the stock minus your strike price, and you will know to the penny how much you will lose from the theta decay, provided you held that contract into expiration. And it doesn't matter if you buy zero DTEs, it's by zero DTEs, I mean the contracts which expires on the same day. It doesn't matter if you buy contracts which expires in a 1 week. It doesn't matter if you go for 1 month. It stays the same. In the money options have both intrinsic and extrinsic value on them. And out of the money options only have extrinsic value on them. And it's one of the main reasons why out of the money options expire worthless. So let's go over a small exercise to see if you understood. You don't have to give me the answer for this, but you can work this out on your own. So open up your option chains and look for SPY 475 calls. 475 calls, which expiring on March 1st. 475 calls, which expiring on March 1st. So check it out and let me know what's the cost of the contract. Let's work this first one together. So open up your option chains and look for SPY 475 calls. And this is expiring on March 1st. And let me know what you see. What's the cost of the premium? How much you have to pay in order to just open this contract? You guys can check it out and let me know in the Zoom chat. So on our hedge, it's cost around 1457. Beautiful. So, which means you have to pay $1,459 to open this trade. So let's do a small calculation together to identify what's the intrinsic value on this contract and what is extrinsic value on this contract. All right. So what's the current price of SPY? If you're having 24/7, don't worry about it. The current price, which they closed on, is $482. If you want to find the intrinsic value of this contract, just subtract the current stock price minus the strike price of whatever calls you're planning on purchasing. And here it's 475. So it's pretty simple. Subtract the current stock price minus the strike price of 475. $976.30. Interesting. 7. Beautiful. So now in the 1459, that's the money which you paid. In that, $700 is the intrinsic value. And the other $760 or whatever it is, that is extrinsic value. Simple as that. And now, let's say you hold on to this contract until expiration. Guess how much money you will be losing with the theta? How much money the theta is going to be eroding over? Theta is not going to touch that $7.64, which is the intrinsic value, by the way. It's only going to erode over the extrinsic value of your contracts, also the time value, which has been baked into your contracts. The beauty about extrinsic value is further you go down the expiration, the more further you go down, like let's say you go like 1 month out, 2 months out, 3 months out, the extrinsic value is going to be higher than that of the intrinsic value on your contracts, because you're buying more time. You're buying more time for the contracts to work in your favor. So let's do another exercise, and now let's do it for the put side, and you'll see it's a bit different. So check out for the same expiration, 490 puts. What's the price for 490 puts for March 1st expiration? Check it out. This is very important, by the way, because this is where the options journey begin. From here, we're going to navigate towards option Greeks. And from option Greeks, we're going to navigate towards the risk side. And all these becomes an important thing to keep an eye out for. So 490 puts are going for $10.03, according to Kevin. All right. So now, in order to calculate the intrinsic and extrinsic value of this put, so before we get into the 490 calculation, the 490 puts are $5 in the money, by the way. So if you want to calculate the spot price for puts, SPY closed at $482. Now, this is the 490 puts. For puts, you're going to subtract 490, the strike price of the puts, minus the current spot price, which is 483. 490 minus 482, which will be somewhere around $8. In that, $8 is the intrinsic value, $2 is the extrinsic value, and let's say SPY closed somewhere around 490 and then they just absolutely traded flat and they closed at 482 by March 1st, you're just going to lose $200. Now, quick math. 490 is the strike price which you're buying. This is for the puts, by the way. It completely switches over for the put side. 490 minus 482.30, which will be $8 approximately. And your current money which you used to pay for this is 1,003. So your intrinsic value is $800 and your extrinsic value is $203. And by expiration, let's say SPY just trades absolutely flat without moving at all, you're going to lose just the $203 by retaining that $800, which is the intrinsic value. I hope the calculations made clear. I hope the intrinsic and extrinsic value made clear. And you can understand, like, why should I even know this? Just tell me, like, what strikes should I pick? You should absolutely know this because it's going to help you with the strike selection. These are all the basics. These are all the fundamentals which everyone need to know. If you're trading options, you should know all these things. And all these things, knowingly or unknowingly, is going to answer that question of which strike price is the best. Picking the strike price with the good intrinsic value baked in it has its own advantages. Picking the strike price which has both intrinsic and extrinsic value baked in it has its own advantages, especially if you're doing leap options. These are the type of strike prices which you should be picking. Strike price which has a lot of extrinsic value and a lot of intrinsic value alongside with it, especially if you're planning on holding something for much longer. So even when you're wrong, you shouldn't be letting that contract expire worthless by buying something like $10, $15 out of the money. Only in the money options have both intrinsic and extrinsic value. Out of the money options have no intrinsic value at all. So let's say SPY is trading at 482, and let's say if you buy 485 calls, all the money which you pay for, it's just extrinsic value. There is no intrinsic value on out of the money options. It's all extrinsic. Just to recap, there are the premiums that you pay for the options are split into two, intrinsic and extrinsic. Only in the money options, in the money strike prices have both intrinsic value and extrinsic value on them. It's easy to calculate. All you got to do is subtract the current stock price minus the strike price for calls. And for puts, you got to subtract the strike price minus the current spot price in order to get the intrinsic value for both of them. So I hope it's clear. And now we're going to move into the most important aspect, which you will see on every single strike price of your options. The Greeks. I'm pretty sure you must have heard about delta and theta. And I can guarantee that you might have heard about theta because you might have seen this term thrown around. Oh, I held it for so long, the theta ate my contract up. Really? Well, we'll talk about it. So there are like 5 different types of Greeks. Number 1 is delta. Number 2 is Vega. theta, gamma, RHO, rho. And RHO, well, we don't use that a lot. It doesn't impact us, and we are not in a raising interest rate environment anymore, so it doesn't concern us, but we'll still go over the basics of it down the line. We're also going to talk about implied volatility. So the earnings seasons are nearing. So I'm pretty sure you're going to see a lot of new traders looking at the markets and just automatically think that, oh, all earnings are coming, the stocks are moving big time. So if I buy an option before the market closes and the stock moves in my favor, I will be a millionaire in a day overnight. Well, we're going to talk about why you're wrong in 3 different ways. So that is called as well implied volatility crush as well. We'll go over that too. First things first, we're going to talk about delta. And if you have traded shares, this is where we're going to start. This is where we're going to start. And let's say there's a stock trading at $10 and you buy 100 shares on the stock. It moves up $1. You're going to make $100 because you're holding 100 shares. For every dollar the stock price moves to the upside or to the downside, you're going to make or lose $100 on the share. And let's say you buy like 50 shares on a stock and it goes up $1, you're going to make $50 for that move. And let's say you're buying 25 shares and it moves up $1, you're going to make $25 on that move. Just like that, for every single strike price you pick, the option strike price actually tells you how much money you will be making or losing for every dollar move in the stock price. For example, let's say tomorrow morning SPY opens at 482, and then as soon as the market opens, you buy a 482 call, which expires on the same day. And let's say you buy 482, and let's say you have some other users buy 485 calls. Let's say some other user over there buy like 480 calls, doesn't matter. The amount of money which these individual traders, the one who got the 480 call, will be making more money per contract as the SPY goes up $1 compared to that of the trader who bought the 482 calls. And the trader who got the 485 calls will be making the less money out of these two traders because every single strike price has its own delta, which means before you click on the buy button, you got to understand how much money you will be making for every dollar move in the underlying stock price. So if SPY goes from 482 to 483, how much money your contract is going to go higher? Or let's say SPY goes from 482 to 481, how much money is your contract is going to go lower? That's what the delta tells you. Delta tells you the amount of money you will be making or losing for every dollar move in the underlying stock price. So let's say you buy 480 calls tomorrow, and you can find the Greeks on your brokerages, by the way. So if you guys use Webull, if you guys use Robinhood, if you guys use TD, if you guys use Fidelity, doesn't matter. It's going to tell you the Greeks, and it's going to tell you every single Greek out there. You'll see something called a 0.60. So whenever you see something in a decimal point, always multiply that with 100. If it's 0.60, which means it's $60. If you see like 0.40, which means it's $40, which tells you that, okay, if SPY goes up $1 from your entry, or any stock which goes up $1 from your entry, your contract is going to appreciate $60 in value. If the SPY goes down $1 from your entry and you're holding calls, the delta is going to tell you how much dollars you're going to be down, how much your contracts are going to be down. That's delta, to put it as simple as possible. It's just going to tell you the amount of money you will be making or losing for every dollar move in the stock price. Why is it important? Why is keeping an eye out for delta is important? That's something which you need to ask yourself. Keeping an eye out for delta is important because you're going to help you to pick the right strike. So if you're new to the markets and let's say you just like, you don't know what to do, you don't know what strikes to buy, and you just buy something like 490 calls on SPY. Let's say the 490 calls has like a delta of 0.03, which means you're going to be making $3 for every dollar move in the stock price. And for that, you can just buy a SPY share. You can just buy one share of SPY and you will be outperforming SPY. You'll be outperforming SPY just like that. And it also going to tell you how much money you will lose if the trade goes against you. So let's say like you buy like a 480 call, which has a delta of $70. And for every dollar SPY goes down, your contracts will be down like $70 initially. And say you buy like 100 contracts without understanding the risk. And as soon as you see SPY goes down $1, you lost like 7,000. And you're sitting here and wondering, why did I lose 7,000 when, let's say, the guy who next to you who bought like 485 calls and he is only down like 3,000 on that same option. You both got in an identical price, identical time. When you're losing 7 grand, he's losing 3 grand, and you'd be sitting here and asking yourself, why did he lose only 3 grand when I lose 7 grand? Because the strike price which you picked had a higher delta on it, and the strike price which he picked got a lower delta on it. Now, it doesn't mean you're losing more than him in dollar amount. Yes, in percentage amount, you still have a chance, but that guy's position is cooked because he lost more than 95% of his entire contracts, while you still have some premiums left. This is where the delta steps in. As Tamara put in, risk management. Exactly. You will know how much money you will lose before even entering the trade, regardless of the strike price. So before buying anything, go to your option chains, go to the delta, go to the greeks, and look at what the delta value is. If you see the delta value as 0.60, it's just going to tell you, okay, if I'm entering right here, if SPY drops $1 from here, my contract is going to go down like $60. I can afford to lose $60. Yeah, I can afford to lose $60. Then, okay, I can enter this trade. And is that $60 less than 2% of my account? If the answer is yes, yeah, okay, I can take that risk. I will enter this contract right here. This is where, when it comes to the management side, especially if you're trading options, this is where it comes in handy. And the funny thing about delta, the funny thing about options, I put it as simple as possible, but in reality, it's not. The delta value which you see, it's not a constant value. It's a variable. It keeps on changing for every cent move in the stock price. And the funny thing about delta, so when the markets are less volatile, for example, the markets which we have right now, we don't have that much volatility. And yeah, even though you might have seen some days where like SPY goes up $2, down $2, that is not volatility. The VIX is still at around $13, 13 points. And in a low volatile markets, when you buy an in the money option, the higher chances that those options are going to stay in the money. And when you buy out of the money options, there is a higher chance that it's going to stay out of the money. Now, I want you guys to do something right now. Open your option chains, any option, any stock, doesn't matter, any expiration, it all follows the same template. So let's start with SPY if you want. Let's pick a stock, let's start with SPY. So open every single strike price which are in the money. Let's say SPY is at 482, open 480 strike and check the delta. Open 475 strike, check the delta. Open 470 strike, check the delta. You will see the delta going higher and higher and higher towards that 100, towards that 1, as you go more in the money. Now, check for out of the money calls delta. Look for 485 calls, delta on 485. Look for delta for 490. You will see the delta going lower and lower and lower the more out of the money you go. Now go to the puts, try out the same thing. Check out for in the money, look for the delta for 485 strike puts, 490 puts. Now check out the delta for 480, 475. You will see in the money options have comparatively more delta compared to that of the out of the money options. So when the volatility is low, the delta on the in the money options tend to stay the same because, well, markets are not that volatile. When you buy an in the money contracts, that in the money contracts is going to stay in the money. And when you buy out of the money contracts, well, the markets are not moving. So when you buy out of the money contracts, it's going to stay out of the money and it's going to expire worthless. But when it comes to high volatile markets, out of the money options have more probability of expiring in the money, and in the money options have more probability of getting out of the money. So the underlying volatility plays a major role when it comes to the delta. So there's some technical term, we call it as charm. I'm pretty sure most of you guys wouldn't have heard of this. The charm is like, you might have heard about like delta, theta, gamma, rho. We spoke about it before. There's something called as Voma. There's something called as charm. There's something called as vana. All these are secondary Greeks when it comes to options. So the charm just refers to how much your delta decays as the time goes by. So I want you guys to take it as a small exercise and check it out this one. Add any options to your watch list position and check out as it nears the expiration. Look at how delta reacts. It's not just theta which decays your options premiums, by the way. As your contracts nears the premium, nears the expiration, the delta decays away as well. And have you ever wondered, let's say you took a SPY call and 0DTE in particular, something which expires on the same day. And for the first spike, you made $60 and it pulls back from that first spike and goes back to the same area like 30 minutes later. Now, for the first spike, you made like $60. The second spike, you just made 40 and it pulls back again. And after 30 minutes, it pulls back to the same level again. And now you're only up $10. That's not theta, by the way. That's also theta also plays a role, but it's most likely your delta just drops. Your delta drop for every single drop which is getting as the contract leads towards the expiration. The technical term is called as charm. This is what we call CHARM. It just refers to how much your delta decays as the time passes by. And the delta also decays when the volatility fades away. And we'll talk more about this when we cover the IV part of the section down the line. So the delta, to recap, all it tells you is the amount of money you'll be making or losing for every dollar move in the stock price. In the money strike prices have technically more delta compared to that of the out of the money strike price. And in the low volatile markets, it's logical thing to happen is when you buy an in the money strike, it's going to stay in the money. And when you buy the out of the money strike, it's going to stay out of the money. And when the markets get a bit more volatile, when VIX started pushing about 2025, when you buy in the money options, there are more probability that that option is going to expire out of the money. And when you buy out of the money option, the more chances that it's going to expire in the money because the volatility, the stock starts moving. The range of the stock is just getting expanded. So you will see wider range in the stock price. So the chances of you, if you buy out of the money and making money, go significantly higher as the volatility picks higher. So now it's all, think of it like a puzzle piece. The more you look into these Greeks, the more you look into how this delta works, the more you look into how this theta works, it's going to help you select the good strike price on your own rather than asking us like, what strike price should I pick? What's the right strike price to pick? Depends on the market conditions. Are we in a low volatile environment or high volatile environment? If you're in a low volatile environment, why would you pick something which is like way out of the money? Odds are you will never make money if that option is going to expire worthless. Can a delta over? No, the delta is capped to 1. As if you remember the first slide we spoke about, a call option or put option, it's just going to give you the right to sell or buy 100 shares of the underlying equity. If the delta is 1, when the contract goes to the delta of 1, it's just going to mimic you holding 100 shares. 1 is the maximum delta can go, and 0 is the minimum a delta can go. 0 to 1. That's it. 0 means it's going to mimic you holding 0 shares, and which is what you will be when the contract is at 0.01. And 1 is when you have 100 shares. So your option contract is that's just going to behave like you're holding 100 shares of underlying equity. So 1 is the maximum, and delta can't go above 1 when it comes to the options. So I hope the delta part makes sense. So if you have any questions, write it down. We will go over it by the end of this session. All right. So next one, we spoke about this briefly. And this is how an in the money call. These are the graphs, how the in the money and out of the money. We spoke about it before. In high volatile markets, in the money calls tend to stay in the money, and out of the money calls tend to stay out of the money. And same with the puts. In the money put tend to stay in the money, out of the money puts tend to stay out of the money. So this is the graph which just briefly goes over the odds of the delta, how the delta drops when it comes to the volatility. And the next one goes over the time, how the delta fades away. We spoke about charm. This is the graph which goes over the same thing. As the options near expirations, the delta tends to fade away alongside with the theta as well, alongside with the options premium as well. So now, let's talk about theta. Let's talk about what the fuss is all about. So every time you hold the stock, you'll be losing a bunch of money, and let's talk about it. And I just put this math over here to show you guys, it's just not that simple. I am dumbing things down so that you guys can understand the basic concept of it. But the math behind every single thing which I'm saying looks something like what you see on the screen. And I'm not asking you to like memorize the equation and understand, because I'm not crazy. So I'm not going to do that. It's just a brief idea to let you know that when someone puts something simple to you, it's just for you to understand the basic. And this slide, it's just giving you an idea on how little anyone knows about options. Options are a complicated tool. They have a complicated math behind to calculate every single move, every single dollar move which you see on a daily basis. You don't have to understand all of it, but you have to understand at least some of it. You got to understand how things work in the background. You don't have to memorize the equation, but again, if someone is dumbing it down to you to a level where like, well, this is all it is, man, it's that simple. Actually, it's not. And before buying or selling anything, kindly understand the risk, kindly understand what you're getting into. Don't go into this starting to trade options just because you took a course from someone, just because you saw a 10-minute YouTube video. It's not that simple. But we'll talk about the basics. And again, highly recommend you guys to get that book and read it, and you'll understand how little you actually know about options. So let's go over Theta. So have you ever wondered, well, like, let's say you buy a contract and SPY didn't move, and for the first 30 minutes, you are not making money or losing money. And then after a few minutes goes by, let's say 1 hour into market session, your contracts are slowly down like $10 or $20. And it gets afternoon, and now all of a sudden your contracts are down like 40% and the SPY isn't even moving. And those contracts expire in the same day. Well, you got to thank Theta for it. Theta is going to tell you how much your contracts loses the value as the options nears the expiration. And similar to Delta, every single strike price has a theta on its own. Every single strike price. If you go to in the money, they have their own theta. If you go to out of the money options, they have their own theta decay. If you go to at the money options, they have their own theta value on it. Every single strike price has the theta on its own. And the beauty about theta decay is if the stock price is more volatile, you're going to see a higher effect on theta compared to the stock price if it's not that volatile as it is. Let's say you buy a same option strike when the VIX is at 30 and SPY is just moving up $5 and down $5 and you just held it to the expiration. Those contracts are going to be losing a lot more money when it comes to the theta decay compared to that of the market environment where SPY is just moving $1 or 20 cents every 30 minutes or 40 minutes. And the markets are more volatile. You'll see an effect of theta higher. And now the funny thing about theta is the rate of decay, the rate of theta decay, it's going to be way higher when it comes to the out of the money options. When I say all these are puzzle pieces, you'll see how it all connects together now. When we spoke about intrinsic and extrinsic value, remember how we spoke about only out of the money options have only extrinsic value on them? By expiration date, it's the job of the theta to just lure it to just decay every single penny from these out of the money options. One of the main reasons why, if you lose money on options, those out of the money options always expire worthless. Always expire worthless. They expire worthless because it's the job of the theta to destroy every single one of the premiums which is left over there. And when you look over the in the money options doesn't expire worthless because they always have intrinsic value baked into them. So the rate of decay on an in the money, out of the money options will be way higher compared to the rate of decay of the in the money options. And the funny thing about the theta is that in the money, doesn't matter if you buy in the money, doesn't matter if you buy out of the money, doesn't matter if you buy out the money. They are all going to start decaying at the same rate at the beginning stages. But as it gets close towards the expiration, the theta decay slows down for in the money and out of the money, because out of the money, almost all the theta has already been decayed. It's nearly expired worthless. It's already out worthless, and it's not going to be accelerating as fast as it is anymore. In the money, all the extrinsic value is gone. So there is nothing for the theta to decay. But it's this at the money options. Let's say SPY is trading at 482, and then you buy the 482 call or 482 put, which is at the money strike, which is where you have a lot of premiums left. You have both intrinsic value and the extrinsic value. That's going to be the main target for theta. You'll see the theta getting more accelerated into this at the money options compared to that of in the money or out of the money when it comes to the expiration date, as the contract's nearest expiration date. Why? Because when it nears the expiration date, almost all the extrinsic value in the money options are already been decayed off. And if your contract is like $5 out of the money, there is nothing left for the theta to erode away from there, because that contract is already worthless. The only contracts which you see some juice left is something called as at the money, which is exactly at the strike price where the stock price is. If SPY is trading at 482, 482 strike price will be at the money. If Tesla is trading at 215, 215 will be something called as at the money strike price. This is something funny. This is something interesting which happens when it comes to the theta decay. So now, to recap, theta refers to how much your contract loses in value as it nears to the expiration, number one. And number two, in the money, at the money, or out of the money, doesn't matter which strike price you pick. Let's say you go for 1 month out expiration, and let's say you buy one for in the month, let's say you buy one for weekly expiration, and let's say you buy one for 0 DTs. When you buy it at the initial stages, doesn't matter if you buy in the money or out of the money or at the money, it's going to start decaying at the same rate. But as it nears the expiration, you will see in the money and out of the money decay slowing down. The rate of decay slowing down on in the money and out of the money. It starts accelerating even more when it comes to the at the money strike prices. You'll see the effect of theta decay more on at the money strike price compared to the of in the money and out of the money. And the last thing, to recap every single thing, whatever we said, out of the money options doesn't have intrinsic value, which puts it a prime candidate for theta. One of the main reasons why you see out of the money options expiring completely worthless, whereas in the money options still have some juice left in them. And this is the basic formula for how the theta keeps on updating as the day goes by. And when you see the Greeks keeps on updating, well, that's how they do it, which is behind the scenes, behind the closed doors. Well, I'm not going to sit down and ask you to explain it and bore you guys to death. If you're interested, and if you're a nerd like me, just like go back, and the book name of the book is Options, Volatility, and Pricing by Sheldon Nadenberg. Well, something to look into. And you don't have to understand it all, but well, something to see. This is how complicated options are. It goes over how these options premiums are calculated and what you're dealing with in real time. What you think it's easy on the blanket, on the outside, all this goes behind the scenes. All this goes behind the scenes, like how certain premiums are calculated and what time should we buy certain contracts, what time is best to buy in the money, what time is best to buy out of the money. How will you understand what to do when you don't even understand what you're dealing with? So look into it. It might open up some of the eyes on how little you know about options. So now, earning seasons are nearing. A lot of, say the name of the book again, it's Options, Volatility, and Pricing. Sheldon Nadenberg is the author. So before we step into Vega, if you guys have any questions on delta and theta, let me know. Is it better to increase the delta by buying multiple contracts further out of the money or buying one contract closer to the money with the same delta? All right. Buying multiple calls doesn't change the delta of that particular contract. It doesn't matter if you buy 10 contracts of something in the money or out of the money. The delta of that particular contract doesn't add up. The delta which you're exposing your portfolio to adds up. Like if you buy like 10 contracts of something with a delta of 0.20, you are exposing your portfolio to like somewhere around $200 to the upside, 200 delta to the upside. That doesn't mean just because you buy 10 contracts, the delta of that particular contract changes. The delta of that particular contract still stays at 0.20. It doesn't matter how many contracts you buy. And if you buy one contract of in the money strike price with a delta of 80, that doesn't mean the delta, if you buy 10 contracts of the same strike price, it doesn't mean the delta of that particular contract changes. So what's better and what's not better? How much are you risking by buying 10 contracts versus how much you're risking by buying just one contract of in the money? It boils down to your risk management. It boils down to the position sizing. It boils down to the position management and nothing towards what we spoke about when it comes to the delta of the particular contract. So when you buy something for 0.20, all it tells you if the stock price goes higher, the delta is going to go higher alongside with it. You're going to be making or losing $20 for every dollar move in the stock price. And when you buy like something with 0.80, all it tells you is, okay, if the stock price starts pushing higher, you're going to be making or losing $80 per explanation, for $80 per dollar move in the stock price. That's all it tells you. So what's the average hold on a 1 month call? Do you take profit at 3 hours? And again, the questions boils down to the execution standpoint. And the 3 hours, 2 hours, 1 hour, all are execution side. So now what's the average hold on a month call? Well, that depends on the strike price. That depends on the delta on the same. That depends on the theta on the same. That depends on what the underlying stock price is doing. So the point of this class is to understand how your option contracts move. When you're holding something into the expiration, what makes that option contracts make or lose money? That's the point. So where you're going to cut, that boils down to your initial plan. That comes to the position sizing, that comes to the position management side of things. So with that being said, I hope that clarified your delta question when it comes to the delta. And this is where we're going to step into one of the most important aspects. And I come across this question or the statement or the whining from the new traders every single earnings season. They're going to buy a bunch of options into earnings. And the next day, the stock price is going to move up like $10 or $20 after earnings. And they're going to be the happiest person alive on the after hour session. They're going to be like, tomorrow morning, I'm going to be making a lot of money. Or it goes down, they'll be having a bunch of puts, it goes down, and the same bullshit. I'm going to be making a lot of money. I'm rich by tomorrow. And then they wake up the next day, market opens, it gaps down like $20, and their puts or calls opens down like minus 60% or minus 70%, even if the stock price moved like $20. Even if the stock price moved like $10, $5, they're still their options are still down like 60%, even if it moves in their direction. And then they'll be like, market manipulation, they just hedge funds took my money, Robinhood took my money. No, there's a reason behind that. There is this term called IV crush, implied volatility crush. And please understand this term before you gamble into the earnings, especially into this earnings season. There's a reason why a lot of people who know what they're doing tell you not to trade earnings, because it's not even a coin flip, because it's not even 50-50 anymore. You're going to lose money. that's the higher probable chance. You're going to lose money, especially if you're buying options, buying calls or puts into earnings. You're just gambling. And it is called as gamble because there is no way for you to set defined risk. Number one. And when you, who's just starting out trading, knows that a stock can either move up big time or move down big time, do you think options market doesn't know that? One of the main reasons why you see calls or puts getting way more expensive the week into earnings is because of the same. Option markets, or the markets in general, are gonna price in the expected move. Let's say you're expecting that markets are expecting like a 2 or 3% gap up or gap down in a particular stock. They're gonna price that in. The option prices which you're seeing into this week for any companies which are reporting earnings for, you're gonna see that them pricing in that expected move into the option prices. So number one, you're already overpaying for your premiums. Number two, there is no way for you to set your stop losses. And number three, you're going to lose money if the stock price opens flat. You're going to lose money even if the stock price moves in your favor and if it didn't move to that expected move range. And number three, if the stock price goes lower, you're going to be losing a lot more than you lose on a regular day-to-day basis by just holding on to a position overnight. So this is what we call as implied volatility crush. Markets have an expectations and they price it into an option change. And if that expected move never happened, you're going to see a huge drop in the options premium the next day as they rip out all the priced in premiums once the market is open. Now the uncertain event is made certain because the stock reported earnings and you got the earnings, you got the stock price move, and it didn't meet the market's expectations, and they're going to rip out all the priced in premiums away from the option chains, and that's why you're down even if the stock price moves in your favor. The technical term for this is called implied volatility crush. And there is a Greek which is going to tell you exactly how much your premiums are going to go up or down for every percentage move in IV, which is implied volatility. That Greek is Vega. And when you open your option chains, you'll see this thing called Vega in there, followed by implied volatility, which will be in a percentage tab. And let's say if IV goes up from 30% to 31%, which is 1% increase in IV, or let's say the IV goes up from 32% to like 37 or 40%, you will see this Vega telling you how much it's going to bump up your contract sizes, contracts profits. Or let's say the IV goes down from 40% all the way down to 30%. That's a 10% drop in IV. The Vega is going to tell you how much it's going to kick your contracts right in the curb, right to the curb. The Vega is the Greek, which is telling you that how much your option contracts is going to move for every 1% move in the implied volatility. To put it simple, that's all it is. The higher the percentage of implied volatility, the more expensive your options premiums get. Have you ever wondered, let's say like, if you traded AMC or GME during that hype in 2021, how expensive were the option contracts after that squeeze actually happened? Have you seen the pricing of GME when it was trading at around like $300? Very expensive, because it was expensive because the implied volatility was at 600% during that time for GME and AMC. 600%. Higher the IV, higher the money which you pay for the options premium. Why? Because markets are expecting a more volatile move, so they're just going to price it into the options. So you're going to see the implied volatility jump higher. You're going to see the Vega jump higher. Vega just pushing the option contracts beyond 600% in IV is really high. High IV is good for selling options. Exactly. So when you see something with a higher IV percentage, I can understand what's the nominal IV to look out for when it comes to trading stock. That's going to be the next follow-up questions, especially if you're new. Every stock has an average implied volatility. Every stock has a mean as an average implied volatility, which has been trading on for years and years and years. That's what we need to look out for. Tesla will be having an average IB of 60%. SPY has an average IB of 12%. QQQ has an average IB of somewhere around 13, 14%. And every single strike price has its own implied volatility, by the way. Every single strike price has its own Vega. All that Vega is telling you is how much your option contracts is going to go up or down for every % change in the implied volatility. And we spoke about earnings season. We spoke about IV crush. And before buying calls or puts blindly into the earnings, always remember that. If you know that the stock is going to go up or down, markets already know that too. They are pricing it in already. You can get lucky and you can make money. You can gamble into it and you can make money. Again, getting lucky is not a strategy. Don't get sucked into it and lose a bunch of money and get confused the next day and feel like, oh, why am I down? It's went up. Like stock, I thought when this, I'm going to make money if the stock goes up. That's what call options are for. Well, welcome to the other side. Option markets are way smarter than you think it is. And if you want to learn, dive deeper into the same, look into IV crush. IV crush, implied volatility crush. That's the technical term. So that's Vega, to put it simple. For every % move in IV, how much your contracts is going to go up or down. So that's going to tell you, that's what the Vega is going to tell you. So as the volatility goes higher, the Vega of in the money and out of the money contracts increases, while at the money options, the Vega stays the same. So let's say you have SPY 485 call, which is like $3 out of the money. And as the volatility goes higher and higher and higher, these out of the money options is going to have increasingly higher amount of IV %, which is going to push the Vega higher. While the at the money options, the Vega increases steadily. It's not going to be as volatile as in the money options or out of the money options. So let's see. Does buying a put option have to do with less delta and more theta? Actually not. Just like you buy a call option, put options also have its individual delta, individual theta, individual Vega. But the only difference is you're going to see everything in negative. Put options will be having negative delta. So all you have to do, don't worry about the negative sign. It's just telling you how much money you'll be making for every dollar move to the downside, just like calls. But the only difference is you will see negative signs on delta when it comes to the put option. Multiply 100 on Vega. Yes, exactly. Why does it say steady at the money contracts? All right. It is steady at the money contracts because let's assume this. We spoke about how theta affects in the money and out of the money less compared to that of the at the money contracts into the expiration. The theta's effect is going to be a lot more in at the money contracts compared to that of the in the money and out of the money. But that's not the same with Vega. When the volatility of the underlying increases, markets are going to price in the expected move into the way out of the money contracts. Whereas, like, let's say you take SPY and VIX is at 30. SPY has an expected move of like $10 every single day. You're going to see the premiums more expensive for the out of the money contracts because the probability of the markets to hit that particular level, way out of the money, is way higher when the volatility goes up. Whereas the at the money, it's just going to be steady because the stock price keeps going higher and higher and higher. Whatever the at the money contracts in the market opens won't be at the money anymore as the markets keep going up and up and up. Let's say you buy 482 calls at open and the market just goes up to like 485, 486, 487. And now your 482 calls is deep in the money. It's not at the money anymore, at the money strike anymore. And now let's say you buy 486, which is like $4 out of the money at open. That is an out of the money strike. And now the volatility the stock price keeps on increasing. Now, that contract is going to appreciate more and more and more in value because number one, when we spoke about delta, we said how like in the high volatile markets, the in the money strike prices has higher probability of going out of the money, and out of the money strike prices have higher probability of getting in the money. When we spoke about delta, we spoke about this. Just like that, as the stock price goes higher and higher and higher, once at the money strike price is now deep in the money or deep out of the money. So it's less likely for the at the money to stay at the money in the volatile markets. So that's one of the main reasons why it stays like it's kind of steady. Vega is steady with the at the money strike price because the markets are going to be moving up and down in the high volatile markets. So the volatility increases, and when the volatility in the high volatile markets, the Vega on in the money and at the money increases now and then are going to be more volatile. It's going to move the options premiums more volatile when it comes to way out of the money options, way in the money options, as the at the money strike price just stays steady. When the at the money strike prices are the most impacted when it comes to the theta decay or when it comes to the delta, well, that's about Vega. All it's going to tell you is how much premiums it's going to change for every percent move in the underlying implied volatility. So I hope this makes sense. I hope the Vega makes sense. So if you guys have any questions about the Vega or Delta or Theta, let me know now before we step into the last one, which is Gamma. Good? All right, let's go over Gamma right now. So do you guys remember when we spoke about delta, how we said like the delta values are not something which is constant and it keeps on changing for every dollar move, for every cent move? Gamma is just going to tell you how much the delta changes for every dollar move in the stock price. And to recap, in delta, we spoke about if the stock price moves $1, delta is going to tell you how much money you'll be making or losing for every dollar move in the stock price. Gamma is going to tell you how much the delta is going to move for every dollar move in the stock price. So you're going to be seeing something called as delta. You're going to be seeing something called as gamma. You're going to be seeing something called as theta and vega in your option Greeks chain. And none of these values are a constant. Every single thing is a variable. So now, all that gamma is telling you is how much the delta is going to increase or decrease in value as the stock price moves up $1, moves up $1, or moves down $1. Delta is telling you how much money you'll be making or losing in your option contracts for every dollar move in the stock price. Gamma is telling you how much money the delta will be increasing or decreasing for every dollar move in the stock price. That's the connection. That's the connection between the delta. That's the connection between the delta and the gamma. So when it comes to the at the money strike prices, gamma will be the highest. It's pretty simple. It's a pretty logical thing to look into. We spoke about how delta max out at 1, and we spoke about how delta, the lowest point of delta is 0. When you go to the deep in the money options, let's say you buy a deep in the money, like if you go open your option chains and look at SPY 460 strike, which expires tomorrow, the delta will be somewhere around 0.98. The gamma on these strike prices are going to be way lower than the gamma on the strike on the at the money strike price, where the delta is somewhere around 0.50. Now, same thing for way out of the money. Let's say you buy like 550 call if it's even existing. The gamma on those are going to be way lower as well, out of the money, because the delta is way lower and the odds of that contract going in the money is like non-existent. There's no way that SPY is going to gap up like $100 tomorrow. Absolutely not. The odds are significantly low, and it's not going to happen. So the gamma is greatest at the money strike price, because let's say you buy a 482 call with a delta of 0.40 and SPY moves up to 485 in the same day. The goal of this gamma is to push that delta towards 1. That's the goal. And that's going to happen more at the money strike prices rather than something which is deep in the money or deep out of the money. And this is one of the main reasons why option traders typically prefer trading at the money strike price options, because it's not much affected by Vega, number one. And the theta is going to impact more to the at the money strike prices rather than deep in the money or deep out of the money. It's going to give them that volatility push. It's going to give them that have you heard this term gamma squeeze? The squeeze of the gamma is going to be way higher when it comes to the at the money strike prices rather than to that of the deep in the money options or deep out of the money options. At the money contracts is going to stay more volatile. It's going to move. And as a trader, as an option trader who is looking for the momentum, who's looking to capture the momentum, that's the strike price which traders typically go for, because they're going to get that move in a short period of time with the at the money strike prices rather than buying deep out of the money options for like chump change to make like $2-3 move and then calling it a huge win, or way in the money options where like it's for that you can just buy 100 shares instead of buying the same way in the money options, because the growth is not going to be there when it comes to the percentage basis. If you want to capture the quick percent basis at the money options or the go-to, because they're the most impacted they're like most impacted by the theta, they're most impacted by the gamma, which is going to squeeze up the delta more and more and more as the stock price works in your favor. You're going to be know you're right real quick, or you're going to be know that you're wrong real quick, so that you can either enter and exit on a quick time. So this is gamma. To recap everything all at once. First thing, delta is going to tell you how much money you'll be making or losing for every dollar move in the stock price. If you buy a 482 call, which has a delta of 0.60, if the SPY moves to 483, all it's going to tell you is your contract is going to appreciate by $60 in value. Now, what's going to happen if SPY moves up to 483? Now, this is where we move into gamma. Gamma is going to tell you how much the delta is going to increase for every dollar move in the stock price. Number two. And number three, theta. Theta is going to tell you how much your contracts depreciate in value as it nears the expiration. And theta is only going to get affected for the extrinsic values of the options. Theta is only going to affect the extrinsic value of the options and not the intrinsic value, which is one of the main reasons why out of the money options always expire worthless, while in the money options always have some premiums left over because those are intrinsic value, and theta doesn't affect the intrinsic value of the options. And number four, Vega. Vega refers to how much your option contracts go up or down for every percent move in the implied volatility. Implied volatility is nothing but the market's expected move into the stock price. So, and there's something we spoke about, something called as IV crush, which refers to as if the market price in an expected move, and if that expected move isn't met, well, your contracts are going to lose a bunch of money. So if you're going to trade into earnings, if you're going to gamble into earnings, don't get confused when the market, even if it moved in your direction, you lost a bunch of money. That's mostly because of the crush in implied volatility. So with all these, what we mentioned about, those are all just the tip of the iceberg, which are bare minimum. It's like going to kindergarten when it comes to options. It's like learning A, B, C, and D's. That's it. So there is a significant risk when it comes to trading options. Well, if you've been trading options without understanding these basics, more or less, well, I hope this taught you what is what. Again, kindergarten stuff. This is not all of it. And I can debate that even with knowing all these things, you're still not ready to trade options, because people get into it. without knowing about position sizing, without knowing about how to manage their positions, without knowing about how to managing the risk, because they just treat options as like, oh, I just want to get in, I just want to make a quick $200 and I just got to get out. Well, most likely scenario, you're going to blow up trading this way rather than making any money. Absolutely. That's the probability. Oh, but I'm different. Well, I have heard that from a lot of traders. It's inevitable. Without risk management, doesn't matter how hard you work, doesn't matter how different you are, math doesn't discriminate. So manage the risk. If you're working hard, do it the right way. So the next thing, basic FAQs. The first question which you get all the time, is it better to buy in the money, out of the money, or at the money? Options. We already discussed that. At the money options are typically preferred because of the push which it can give. And this is not something which is a binary question. Traders want like, which is best, this or that or that. If you're trading covered calls, people prefer out of the money. You're not going to sell in the money covered calls when it comes to the options. Why would you do that? Let's say like you're holding a share for like $10. You're not going to sell a $9 strike price call. Well, because if you get assigned, they're going to sell your shares, which you bought it at $10 at $9 each. You're going to prefer out of the money. And again, you're not going to exercise your out of the money calls either, because why would you want to buy something, buy a share, which is at like $11 when the stock price is just trading at like $9 each? You're not going to do that either. Again, this is not a binary question. Which strike price should I buy? Which strike price involves less risk? Every strike price involves risk on its own. We spoke about it when we spoke about the Greeks. Every strike price has its advantages and disadvantages on its own. It depends on the market volatility. It depends on the market conditions. In the high volatile markets, out of the money options has more likelihood of turning in the money, whereas in low volatile markets, in the money options have more likelihood of staying in the money. Depends on the market volatility. The answer to this question changes. You can't just say out of the money options are always the way to go. Absolutely not. Because you're going to lose your money every single time you buy it when the volatility is not there. So again, depends on the market volatility. In a low volatile market, you'll be much better off just buying something with a good intrinsic value on it. So even if the market is just trading flat, you'll still be having some premium left in the options. The next question will be how to set stop losses when it comes to the options. Again, position sizing, position management. Without this, risk management doesn't exist. How do you set the stop losses in the options? It depends on the brokerage. The problem with these options, we spoke about a lot of things and you saw how complicated the things got all of a sudden. It's not just set 10% of your options in your stop losses. Why? Because options are not meant to be traded the way most of you guys trade. It's not meant to be scalped or day traded. There's a lot of other instruments which are there to take advantage of the same stuff, which is going to give you a better control on your risk. For example, take futures, for instance. You're going to have better control on your risk compared to that of what you do with options, because the stops are going to get hit every single time a certain price is hit. And with options, it doesn't. Like, how many of you have set the stop losses and it just blew right through it? It never got hit. It never gets filled. Well, because the premiums are volatile. Option premiums moves based off of multiple conditions. And I'm pretty sure every single brokerage has their own way of letting you set stops when it comes to options. If you're trading Robinhood, that's completely out of the question. And if you're using Robinhood, then all I can tell you is don't trade options and you're screwed. And or Robinhood doesn't have any decent way to set stop losses. I'm pretty sure TOS has one, Fidelity has one. I think Webull has one too. So if you want to trade options, well, if you want to set stop losses with options, avoid trading options on Robinhood because it doesn't have a proper way to manage the risk. Try Fidelity, try TOS. You'll be having much better control over your positions compared to that of what you do when it comes to Robinhood accounts. And I don't know if you have OCO orders with Webull. Robinhood has that with shares, but I don't think it has its options. I don't know much about Webull. If you haven't, if you can manage the positions with trailing stop losses or OCOs or whatever it is, stick to Robinhood, stick to Webull. But if you want to pursue the Robinhood, if you want to scalp with Robinhood, well, options are not the way to go. They need a lot of work to do in order to make things easier. So yeah, if you want to trade options, well, there are a lot of other brokerages to do so. So look into those. Dump it. Schwab is good. Exactly. A lot of other good brokerages which have solid grasp on the risk level when it comes to the options. Robinhood is not one of them, especially with options. For shares, I don't have any complaint for that. But when it comes to options, well, look for other brokerages. But again, that doesn't mean that just because you switch brokerages, you'll automatically start to make money. Well, it just means that it's going to give you a better control over your positions. That's it. So something to look into. Should my contract reach my break-even price to appreciate in value? So this is also one of the questions. So let's say like if you're a new trader looking at the options and you see the break-even price of a contract is at $5 away from expiration, the first question you ask yourself, okay, should I hold this contract until expiration to make money, or can I just buy and sell immediately to make money? Should it go to the break-even price for me to make money? Absolutely not. It doesn't need to go to your break-even price when you got it in order for you to make money. Let's say you buy a contract, and as soon as you buy it, it just goes higher. You're going to be up. You're going to be up on those contracts. Those contracts are going to appreciate in value, especially if you buy calls. And same with puts. If you buy puts, if it drops down, those puts are going to appreciate in value. And you can sell at any time you want, especially if you're scalping or day trading. It doesn't really matter. The break-even price is just telling you that by expiration date, the price of the stock price should be trading above that break-even price for you to make any money, or closing exactly at that break-even price for you to not make any money or not lose any money. That's what the break-even price tells you. So it doesn't have anything to do with where you buy and where you sell. You're going to make money if the stock price goes up immediately as soon as you buy it, or you're going to lose money if it starts dropping against your direction. So you're only going to worry about the break-even price if you're planning on holding on to the options into your expiration. So what expirations are better? Odds of making a consistent win is better with shares than with options. Not even, this is not about age, Carlin. It goes for younger folks as well. But yes, if you want to be consistent, it's way better to just buy trading shares compared to that of trading with options. And I can guarantee you that if I just trade shares with my shares account, which I do have right now, members know it already, that account on a percentage basis will outperform any account which only trades options. I can guarantee you, I'll be here by the end of the year. I will share my performance. If anyone in here just purely trade options, share their year-to-date performance by the end of the year. I can guarantee you that account is going to outperform anything, any options only trading account. There is a reason. I mean, the US Investment Championship, if you look at the data, year after year after year, let's say if they take a $25,000 category or $1 million category, shares only account always outperforms the options only account. And the reason is you can easily control risk. That's all it is. When you can manage the risk, you can easily outperform the markets. When you have a good control over the risk, rest of everything else just sits right in place. So I heard from someone that on our edge, option contracts move much slower. So when increasing in value, it moves against. Not really. Nope. That is a false statement. That's not how it works. That's not how any of it works. So it is kind of hard to set stop losses or manage your positions with Robinhood. True. But whoever told you that most likely lost a bunch of money, and instead of taking responsibilities, they're just blaming it on their brokerage. So you'll meet a lot of these people. So don't take them seriously. That's not how it works. It doesn't go up slowly and then like when it starts dropping, it starts dropping fastly. That only happens if the stock drops faster. And as I said, they might have lost a lot of money by going against it. So instead of taking responsibility, they're just blaming the brokerage. So call them a clown and move on. It's not the Robinhood's fault. It's going to be the same for any brokerage. What is the best strategy to ensure an order is filled to close a contract during high volatility on our hedge? Okay, so for buying or selling, to close, okay, my bad, I didn't read it properly. To close a contract, there is unfortunately no ways. Number one, especially when it comes to Robinhood, especially when it comes to options. If the stock is more volatile, and even if you have a limit sell and the stock is just gapping down, well, it's going to gap right through your limit sell stop loss. And there is no way for you to get filled. You'll be sitting ducks looking at your contracts, losing a bunch of money. The best thing to do at those moments is just do it manually, especially if you're going to stick with RH. Well, manually getting stopped out is the best way to do it. And the problem with manually doing it is you won't be having a fixed stop loss. I can just open my position with the proper position sizing, and I can just put my phone down and I can just go to sleep, and I can just wake up to see like, okay, did I get stopped out? Okay, great, I got stopped out. Or did I get kicked out for profit? Yeah, I got stopped out for a profit. Great. I can do that with shares, but with options, unfortunately, that's not the way to go. And even with a proper position sizing, and if they gap it under your stops, it's going to be very brutal for the account. So something to look into. If you want to trade options, look for other brokerages like Fidelity or TOS, only because of the reason that it's going to give you much control, much better control on your risk. Might have to use a market order to ensure fulfillment. Exactly. Yep. So, is there a good intrinsic extrinsic value for leaps to consider? Okay, let's go over it, Aaron. Give me a stock, give me an expiration. We'll calculate it. Every single strike price has a leap, has an intrinsic and extrinsic value on their own. So if you're looking for SPY, let's say 400 strike price, 2026 expiration, calculate calls for 400 strike price, which is $80 in the money, 2026 expiration. I'm pretty sure it'll be somewhere around $70,000-$80,000, more or less. SoFi, January 17th, 2025. What strike price? You guys got to tell me the strike price. You guys got to tell me the expiration and what's the premium it's going for in order for us to calculate. That's how we're going to calculate the intrinsic and extrinsic value. $7 strike price. How much is it going for? And let me know the premiums, how much it is going for. It's easy for us to calculate the amount of money which we will be making, or amount an intrinsic and extrinsic value. Let me know the money of the $7 strike price by the time you type it out. If you're trading on a small account, 0 DTE, how much would you recommend as a percentage for stock? Define small account. What's the range are we talking about? All right, $245. So what's the price of SoFi at the moment? Let's check it out. SoFi currently closed the trading day at $7.49 and $7.50. If you're picking the $7 strike in the $245, $7.50 minus $7 is $50. In there, $50 is the intrinsic value, and the rest all is extrinsic. $195 is extrinsic. So if SoFi closes anywhere under $7 by expiration, or let's say SoFi is just trading absolutely flat into the expiration, the intrinsic value is the only thing which you're going to keep, $50. You're going to lose the rest of it from the options premium. The rest of $195 is the extrinsic value. How did we calculate? Just subtract the strike price minus the spot price. You're going to get the intrinsic value out of that. And XLY 185 call, let's see XLY, what's the price? 185 call December 24th. That is out of the money options, out of the money strike price. It doesn't have any intrinsic value on them. We discussed this earlier. Out of the money options doesn't have any intrinsic value on them. So those are going to expire worthless. With 3K account, you'll be much better off just by trading shares rather than doing options. And you'll see how easy it is to outperform S&P 500 by just trading shares. It is very difficult to control the risk. And if you're trading 3K, the maximum you can lose on a day is $60, which is 2% of your account. You shouldn't lose more than that. So if your goal is to grow your account consistently down the line, total risk you can take per trade is $60, which is no more than 1.5 to 2% of your account. Regardless of if you're trading shares, regardless of if you're trading options, that's the maximum you can lose. There is no excuse in losing like 10% of your account. It doesn't matter if you can afford to lose $300. It doesn't matter if you can afford to lose 200 or 500. Losing 10% of your account or 15% of your account in a single day is not an excusable behavior in any way, shape, or form. And if you want to outperform S&P 500, you cannot be losing like 10%, 20% in a single day when the markets are up like 0.5%. So again, with a 3K account, or even with a $5,000 account, I would just say stop trading options. If you're going to start trading options, at least have like a $15,000 or $10,000 account. And even when you have that much size, the maximum you can do is like 2 or 3 contracts. That's it. 2 or 3 contracts, because the 2 to 3% goes higher. You can afford to lose when you're trading with a $15,000 account. Well, you can afford to lose like $450. Then you can take like 2 contracts or 3 contracts, and you can have a wider stop loss and let things work out in your favor. But with $3,000 account, $5,000 account, absolutely not. Not because you can't make any money, but only talking from a risk standpoint. You'll be taking a way lot more risk, which is going to hinder your growth of your portfolio. It's going to be very difficult to grow your account with that. So something to consider. So I'm going to give you guys the ability to unmute yourself so you can just like ask questions through the voice chat directly. And you should be good to go now. I set a stop limit on Robinhood for options. I always get stopped out. I usually separate stop and stop limit wide enough to kick me out, but feel I'm losing a few cents due to stop limit and stop cap. Well, stop limit and it only works with stocks which has high liquidity. For example, SPY, or with stocks like Apple, stocks like AMD. If you have a wider stop limit, it works. But my point is, if the stock is moving a bit more volatile, let's say you see a massive red candle in an intraday basis, it's going to blow through your stops. It's not going to kick you out. And that's the same regardless of the brokerage. That's the same regardless of which brokerage you use. So if you use Fidelity, if you use Schwab, if you use TOS, there's something called as OCO orders, where you can set your stop losses and also your profit-taking targets at the same time. So if it goes to your profit-taking target, it's going to sell it. If it goes to your stop losses, it's going to sell it. But with Robinhood, you don't have that ability to do both at the same time. You can either set your limit sell or you can set your profit-taking target. You can't do both at the same time like what you do for futures. That's a problem. That's the problem with Robinhood. If you want to sell it, you have to cancel your limit sell for the stop losses, and then you have to sell your options at the same time. That's the problem. What do you think about TC2000? What is TC2000? What is that? Brian Shannon. I've never heard about it. I don't know. I just learned last week TOS. Yep. Which platform has it? TOS has it. Fidelity Active Trader has it. Schwab should have it. Any Tasty Trade should have it. Any reputable brokerage, trading brokerage which has been around for more than 10, 20 years should have it. If you have an option expiration date a month out, do you still use the same stop loss as they were 0-day expiration? Leroy, will your plan completely like different just because you choose a monthly expiration? It's a different Leroy. Leroy McConnell. Oh, we have two Leroys here. Beautiful. All right, so so you have different stop losses when you have different time frames is what you're trying to say. I mean, if you're trading zero DTEs, of course, I can understand that it's most likely going to be a scalp sort of trade or a day trade sort of thing. But if you're going with a monthly expiration, well, it's going to be more or less for a swing trading time frame. But again, even for scalping, even for day trading, I would still recommend taking monthly expiration with the same stop loss. It doesn't really matter because even if you're wrong, this is how I see it as. With zero DTEs, when you're wrong, you're going to lose like 60, 70% of your entire investment in a matter of minutes. But when you take the monthly expiration, and let's say if the stock moves down like $1, you're going to be losing a maximum of 5% or 6%. I'm not a big fan of entering a position with an idea that if I'm wrong, I'll be losing like 60% of my entire investment. It doesn't matter if that 60% is like $5. It doesn't matter if that 50% is like $10 or $100 or $500. It doesn't really matter. Even if I'm just putting in like $50 on this trade, and if that same trade goes down like to $10, well, I lost like almost 80% of my entire investment there. I don't care if I can afford to lose $40. It doesn't really matter to me. From how I see it as is I invested like some money and now I'm down 80% on it. That stage won't happen to me if I just use the monthly expirations, even for the scalping or day trading. And I believe that's a good mindset to have because I don't like to lose 80% of my initial investment just like that, just because I got like 50 cents wrong. And that's not how I trade. And if you're new, that's not how I would recommend you to trade as well. So it'll be good to give yourself some time. Just go for monthly all the time. Give yourself some time when trading. Don't touch zero DTEs. It does a lot more harm than good. TC2000 is a charting software that Brian Shannon partnered with. Oh, interesting. Good to know. I never tried it. If you guys tried it, let me know. Is there a difference between supply and demand? It actually, it's tomato, tomato, mayo, and ranch. That's all it is, D1. And what people call it a supply zone, it's just an area of resistance. That's it. It's a zone of it's the resistance zone. And what people call it like demand zone, it's just the support zone. That's it. It's more or less the same thing. When support, people have like just one line. When people call it demand zones, all they call it is this particular area. When let's say like take Tesla for example, let's say you have a support line at 208 and I'll be having a support zone at 208 to 207.50. Well, what you call as support, I just call it as demand zone because I have a demand zone, I have a zone. Okay, as long as stock is trading between 208 to 207.50, I'm going to keep an eye out for it. That's an area of interest. That's a demand zone for me. And to the upside, same thing. Let's say you have a line of resistance at 212.75, and I have a box 212.75 to 213. That's the zone I'm looking out for. I call it supply zone, and you call it resistance. What is an order block? Well, there's a lot of. Okay, let me put it the simplest way as possible. Let's say you trade a stock, and the order book is going to tell you how many buys and how many sells went through for every single cent. Let's say you take SPY or let's say you take ES. Let's open ES for an instance. ES is just going to tell you, okay, on 4880, that let's say like 20 million buys have been executed. On 4881, like 40 million buys were executed. On 488750, there's a bunch of sell sides sitting in. That's what order blocks are. It's going to tell you at what price, how many buy orders are sitting, how many sell orders are sitting. That's what it's going to explain it to you. And that's the basic way I can put it. I'm pretty sure people who uses depth of markets, DOM, can explain it a much deeper way. But to put it simple, that's what the order block tells you. At a particular strike price or a particular price point, how many buy orders are sitting and how many sell orders are sitting. Where you can find this info, well, you can either use level 2 markets, or there's something called as depth of markets in TradingView. Where will you find it? Let me see. In TradingView, there should be a depth of markets where you can find the buy or sell orders directly. You can do that. And again, depends on where you actually see it. There's a lot of softwares which actually help you out with that information. I have a question about gaps and if they always be filled, or is there a certain time frames? Ernesto, depends on what type of gap we're talking about. And we spoke about it multiple times, but I'm going to explain it to you again. There are like multiple different types of gaps. Number one is common gaps, breakaway gaps, runaway gaps, and exhaustion gaps. And the gaps which gets filled on the same day is called as common gaps. Only common gaps gets filled on the same day. Breakaway gaps, runaway gaps, and exhaustion gaps takes sometimes months to get filled, sometimes years to get filled, and some of these gaps never get filled. It's going to take a long time. And if you want some examples, look at NVIDIA, and they had a massive, I'll just pull it up on my chart. I hope you can see my screen. And can you see the gap up from all the way from here on May of 2023, May 25, 2023? That's a runaway gap. That gap still never got filled. And just like that, go to LLY. Look at LLY, and there is a gap over there, which is around August of 2023, never got filled. And go to Duolingo, DUOL. There is a huge gap from February of 2023, never got filled. So again, not all the gaps need to get filled. And some gaps takes a long time to get filled than the other. Only common gaps get filled on the same day. Breakaway, runaway, and exhaustion takes a long time. Look into it. Just type different types of gaps. You'll see a lot of documents about the same thing, a lot of articles about the same thing. To get the basics, learn the basics, get back to me. I'll give you more examples. It'll be more easier for you to learn once you visualize the same stocks right in front of you. A little off topic, looking to set up a dividends portfolio. Can you recommend 5 stocks? SPY, QQQ, VTI, VOO. You'll be better off just by holding these rather than putting it in a high yield dividend funds. Nope, not a big fan. All these 4 pays dividends, these are index funds, more safer. If you're going to option trade, knowing the basics won't necessarily make you profitable, even if you know the price action on levels. Option trading won't make you it's not that option trading won't make you profitable if you know the basics. Knowing the basics has nothing to do with profitability. Profitability always boils down to how you manage your risk and how you're going to go about position sizing. With options, setting the stop losses is puts into question that you can't manage your positions until the market opens. And if the stock price gaps down, if I'm trading shares, I can just get out of it by 8 o'clock. I can just get out of it overnight. You can't do the same with options. You'll be sitting ducks. You'll be sitting ducks until the market opens, and you'll be watching the money melt away as you see the stock price gaps down over and over and over. Position management is put into question. And number 2,
I didn't know you can get out of your shares overnight, really?
What you mean? Yeah, you can sell anytime you want, Leroy. You can sell anytime you want. And especially if you're in stocks, like if you're trading Apple or SPY or QQQ with shares, I can literally sell it right now if I don't like the price action. I can take profits right now if I don't like the price action. You can do the same with options. And number 2, setting the stop losses. You can't just set a definitive stop losses. For me, if I'm trading shares, I will exactly know to the penny how much I will lose before entering the trade. You can't do the same with options. You can know the estimate of how much you can potentially lose, but you can't get the exact amount. How do professional option traders going about it then? None of the professional option traders just trades calls or puts, just so you know. And if you've spoken to any real professional option traders, the strategies which they have doesn't involve just calls and puts. They go for delta neutral portfolio. They go for selling premiums with options. They go for doing like spreads. They go for doing iron condors. They look for setting up their portfolio in a delta neutral way. If you're only spoken to so-called professional wannabe option traders who just like do calls or puts, well, you didn't meet any professional option traders in your life. That's the problem. Talk to anyone who actually do this real time. Well, go to the CMTs. You're gonna find some of them, or go to the Tasty Trade YouTube channel. You're gonna find someone who actually does option trades for real time, full time. Look at their interviews, and you'll actually see how they actually trade. Like Eric had to do all of those different option trades. Eric never trades options. Eric only trades shares. Eric, I, I, I can guarantee you, Eric doesn't trade options at all.
Yeah, 100%. You don't trade them. You tell them the same thing.
I mean, when you work for S&P Capital, nope. I don't think he did options. I think he traded options intraday. But even when for working for S&P Capital or whatever it is, if you talk to any professional option traders, they're going to look for keeping their portfolio delta neutral. They're going to look for selling premiums and collecting premiums along the way. That's how they do it. And you're not going to see all these like buying calls here, buying puts here sort of traders. You'll only see it in this Discord communities for wannabe professional traders. You'll never see that type of option trading when you go to the professional side. It's going to be completely different. They're going to be looking at the Greeks of Varna. They're going to be looking at Greeks like Charm. They're going to be looking at all these other things before even considering which is worth getting in and which is not worth getting in. You'll see what professional option trading is the more you associate yourself with professional traders. So something to look into. If you want to take that route, well, dive deep into it. Because that makes sense, because everything I've read and watched always consider much more strategies than just exactly. Because it's not just buying calls here at support, buying puts here at support. That's not option trading. You're just scratching the surface. And it works right now because calls and puts are much cheaper. You're going to get your ass kicked when the volatility keeps going higher. And when you can't trade the same way by just buying calls or puts when the volatility is at 30. VIX is at 30, you can't be trading the same way. And that's like a highway ticket to blowing up your account. And I keep repeating the same thing. These are the type of markets where you actually learn different strategies of options. If you want to take this options route, well, might as well do it the right way. Don't get stuck to this like it's so easy to get addicted to these calls or puts because it's so easy to make money right now. Well, when the volatility goes higher, you're going to get the burnt of it because when you're wrong, you're going to be losing a lot more money real quick, real fast. If you want to learn more, look into Tasty Trades account. There's a lot of, they interview a lot of traders, a lot of options traders, that is in particular. Look at how they do it. And these are not people who are trying to sell you courses. These are people who actually posted their trade performance in the Tasty Trade and got invited by the CEO of Tasty Trades to give them an interview. Check them out and hear their perspective. And when you hear the perspective of someone who is not trying to sell you something, you'll actually know the real side. It's only the people who are trying to sell you some nonsense are going to feed you that false narrative that, oh, it's so easy. When you keep on working, you'll just get there. Well, you'll see how wrong they are the more you trade down the line, especially if you're new. Focus on managing the risk. Avoid any strategies which puts that into question. It's simple. The only reason I don't do spreads or iron condors is because I don't want to get. Why will you get margin called if you're trading spreads? I don't understand the point of view at all, Aaron. You won't get margin call if you have a proper management on the same. And even if you get margin call, even the longer leg is going to cover the short legs. You're talking about the worst case scenario. You can get margin call by trading options, regular options. If they assign your calls, if you assign the puts, you can get that. And again, the whatever you said is equivalent of I don't want to drive at all because I might get into an accident. Well, if you drive safe, you're not gonna. It's like not stepping outside of the house at all because you might get into an accident or something. Again, manage the risk, be safe, follow the signals, follow the rules. You might not. And there's something called as early assignments. That's equivalent to some other guy being an asshole and ramming into you. Well, that's going to happen. If you're going to get early assigned, that's the risk. So look into it. If you want to take the options route, might as well learn about all these option Greeks and then start doing spreads, start selling premiums. And if you have a smaller account and if you can't sell premiums, well, trade shares, grow your account to that point, and then start collecting premiums by selling, like doing cash secured puts, or by doing the wheel strategy, or by doing vertical spreads, by selling call credit spreads or put credit spreads, or by doing iron condors, keep the portfolio delta neutral. All these are different strategies when it comes to the options, which you can actually do in a low risk way. It depends on the market conditions. The strategy which you pick differs. So learn about it. And if you have any questions, you already know where to reach out. I'll be here. Let me know, and I'll be happy to clear things out for you. So with that being said, Mario, let me know how. All right, DM me. Don't worry about it. I got you. Hey, I don't see that emoji what you posted. All I got is a question mark. My iMac didn't recognize it. All right. Thank you so much for tuning in. Really appreciate it. So if you guys have any questions, feel free to reach out to me in the DM. And the name of the book is Options, Volatility, and Pricing. And that is by Sheldon Natenberg. That's the name of the author. Options, Volatility, and Pricing. It's not a beginner-friendly book, but that's understanding that book should be something which you strive for down the line. Take it as a challenge. If you don't understand it, go back, study about it, come back again. Well, if you don't understand it, go back again, study about it, come back again. Until you understand this book, you're not ready for options. Don't take it as he's just making it difficult to sound smart. No, it is difficult. It is complicated. Well, that's how you get better. Take it as a challenge, study it. Well, if you want to take the options route, that's one way of doing it. And thank you so much for joining. Really appreciate it. And I'll check out TC00. And Carlene, reach out to me in DM. I will help you out. Don't worry about it. Thank you, Mario. No problem. Thank you so much for joining. And the recording will be posted for the members of the Patreon by tomorrow. And other server members will receive it pretty soon. All right. Good night, everyone.